It's started. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, the nightmare scenario begins, and you've been warned. Let's over to Bloomberg, where we picked today's story up with the headline, Hotel REIT, or Real Estate Investment Trust, says it will likely return 19 properties to lenders. Now, this is somewhat shocking because we've been hearing nothing but how strong the commercial real estate market is, how resilient it is to downturns, and that only during the global financial crisis did prices actually fall, and that was an anomaly. And we've been warning you and saying that prices are indeed coming down. And the way these properties are structured, what you're going to find is they're going to head back to the banks because the banks will refuse to write them down or will be unable to write down the loans enough. And sure enough, now we're seeing the beginning of this. And you have to go back to the 1980s when we last saw a massive banking crisis called the savings and loan crisis. And we're going to look at what happened then and see how the setup now is not much different. Keeping the hotels would have required a pay down about $255 million to extend the financing and $80 million in capital expenditures through 2025, according to Ashford Trust. The equity in these properties is already negative based on comparable sales and brokers' opinions of values. So what's happening now is as these loans come due, what the banks are saying, look, you're going to have to bring your loan value down. You're going to have to bring some cash to the table. And we're at a point where businesses don't have cash and they're looking at the economy saying, look, even if I have cash right now, why would I want to commit it into this market when clearly demand is declining? We're headed into a recession. I might as well just hold on to my cash because I might need it for my other properties, or perhaps in a better case scenario, I'll wait till the crash happens and come back and buy these properties back on the cheap. With higher interest rates and falling property values, many lenders are requiring borrowers to pay down part of the debt or provide additional capital for property expenses in exchange for extending the loan comes due. Through June, hotel values were down just a mere 3% from a recent peak, compared with a 16% drop for all commercial property types and a 31% plunge for offices. Now, notably, we're not seeing the full effects of these property value declines hit the market yet because a lot of these loans aren't due yet. They're coming soon, and that's the problem because the banks are going to have to face the music here is that borrowers are going to walk away from these loans unless the banks write them down. And we've seen already the banks are in no financial position to handle any write-downs. When we look at the weekly data from the Fed and we see, what kind of usage of the facilities the banks are having, they're still using these emergency facilities in a big way. There's no sign that the risk from back in March has abated at all, suggesting now that any further pressure on commercial real estate to the banks is going to lead not to just a bank failure, but a systemic crisis involving a lot of banks failing. And here we can see commercial real estate prices generally remain steady. Now, this data goes back to about 2004, 2005, and shown on a year-over-year rate of change. So you'll notice that anywhere it's above the horizontal black line, and there's a couple blips where it just briefly kind of contracts ever so slightly. And that's not a big deal because you'll notice if we just take out the global financial crisis, which many people say we should, well, you'll notice that commercial real estate prices virtually never fall. But the problem is they're starting to fall now, and if we head into another crisis, well, we can only imagine they're going to bring the banks down with them. Most of the hotels Ashford Trust expects to return to lenders are located in markets that have experienced significant headwinds throughout their post-pandemic recoveries, and a number of these markets are not forecasted to reach pre-pandemic top-line levels until 2025 or 2026. Hotels that will likely be returned include properties with brands such as Residence Inn, Spring Hill Suites, and Marriott. So here what we can see is major markets are experiencing issues. We already know, despite the fact that we've heard that travel this summer is going to go gangbusters, the hotels are saying, look, wait a minute, maybe there is travel, but there's certain markets that's so bad that we don't even want these properties anymore because we could outlay cash, we could put the money down, we could refi them, we could keep running them, but we're just going to lose a lot of money, and there's no point on that. We'll turn them back over to the banks if they made a bad loan. Of course, we know the banks can't take them back. They have no experience running hotels, let alone managing the big decline on their loan book. As Wall Street's new zombies may well be the regional banks as commercial real estate exposure is growing concern for lenders. Now, I love how this is now becoming a problem. You know, we've been talking about for a while that this is the next crisis, is commercial real estate. If we go back to the global financial crisis, it started with residential real estate. Now it's commercial. There's no way to stop it, and we're just starting to see people wake up to this reality. Now, delinquencies are set to rise after a 30% decline in office property values, and almost $1.5 trillion of commercial real estate debt comes due for repayment before the end of 2025. This, according to Morgan Stanley. We've been warning about this and made note that this $1.5 trillion problem is indeed coming. And these problems suggest a slow motion train is coming down the tracks for regional U.S. lenders. Now, keep in mind, for those of you who remember the savings and loan crisis of the 80s that went into the 90s, it was very slow moving. It just didn't happen all at once. It was a gradual process. So now we can expect between now and 2025, as these loans come due, that there's going to be major problems. There will be banks that survive the early rounds of it that will not be able to survive the later rounds unless somehow, by some miracle, the economy turns around. However, smaller banks are particularly vulnerable because they boosted their lending into commercial real estate, and we said they did. We've showed you they've done that in past shows. Just as interest rates begin to rise, obviously looking to do loans. That's their business model. About 15% of U.S. banks now exceed the Federal Deposit Insurance Corporation's guidance from 2006 on commercial real estate loan concentration. That's about double the level 2 years ago, and at least relative to the guidelines, there are some vulnerabilities there. Some, you would say, a massive amount. And the only reason, of course, you saw this over-concentration is because what does the business banks do? They lend money. And so that was where there was demand. That's where they lent. Now they're over-concentrated, and these banks are already in dire shape. You can only imagine now, between now and 2025, as loans come due and they go into delinquency, and other groups like Ashford Trust say, hey, you know what? We don't want these anymore. You take them back. You eat the 30% loss. You made the bad loan. Well, these banks will outright collapse. Supervisors are talking to banks about their concentration in real estate, which is a great thing. At least somebody's at least talking to them what they can do now and how they manage themselves out of this, according to Jay Powell, of course, the Fed chief. And that's great. I mean, it's great that we're at least talking to them. It's like, hey, so what are you going to do? How are you going to get out of this problem you created? And I'm sure the bankers are just staring back at these supervisors, knowing, you know, they're coming from the highest levels of the Federal Reserve and saying, are you guys a bunch of idiots? You've inverted the yield curve. We can't lend here. We can't make money. You've slowed the economy down. You can't see it because you're so fixated on inflation, and you're asking us what we're going to do. There's nothing we can do. We're going to go in upside down as these loans come due. Absolutely nothing can solve this for the banks. And here we can see why this is only going to get worse, because the banks tightened lending standards. We know this is how it goes. We've seen this here. We have the net percentage of banks tightening lending standards for firms of all sizes against commercial real estate prices. That's shown in red. The same chart we just had before on commercial real estate prices. And sure enough, what do you see when banks start to tighten lending standards? I highlighted that in yellow. What happens? Commercial real estate prices go down. So what we can look back to the global financial crisis and say, the tighter lending standards get, the more likely that commercial real estate prices are going to crash. You can see here, just as lending standards tighten a little bit, this is where you see commercial real estate prices flatlining. You see it briefly into the pandemic before, of course, all the stimulus. And now, lo and behold, what are we going to expect? Further tightening, because as we look forward to the yield curve, and we'll get to that in a bit, what are we hearing from the Fed? Massive inversion. This is going to cause banks to further tighten lending standards, cause asset prices in commercial real estate to crash, which is going to topple the banks. And you kind of see this unfolding, and once you understand it, you can't stop it. As commercial real estate values are now set to crater as much as 40% by 2025 in these 6 cities, experts are saying. But one thing that shouldn't be cratering by 40% is your trading account, because if you had CTA-Timer Pro and you were trading just the tech stocks, this is just one example of the many this program finds of trades that are low that you could trade to the upside. Here you can see it said buy the QQQ way down here. Start taking trades right in here. Start adding positions. And many people were afraid to. They said the market's going down. And it said, no, it's not. The market rallied. Then again, the market pulled back and said, no, you could buy in again here. If you missed it or you want to add more, add more. It's gone way up here. And now it's starting to put the warning out to cut some of those positions or raise your stop loss levels. Here you can go back to January 9th. What do we see? It was at max short. This is a model of how the computers are positioned. And then we run a secondary historical overlay. When it gets max short and starts covering, that's the signal to buy. Here you can see it on March 15th, did it again, that pullback. It was buying out of the pullback, said now's the time to go again. And here you see on June 30th, it gave the first of what will be more early warning signals to either start taking some profits or raising your stop loss levels up. It's $30, link in the description below. It's a mere $1 a day. Try it out. If you don't like it, 30-day money back guarantee. It'll change the way you trade. And now we can see commercial real estate is in for hefty price declines across 6 top U.S. cities. And according to this recent report from Capital Economics, so, before it was don't worry about commercial real estate, prices rarely go down. And now not only are we seeing people start to say, hey, you know what, there could be a crisis here. We're starting to see experts say, look, the price declines could be significant. The researchers from highlighted cities dubbed major markets San Francisco, Chicago, New York City, Los Angeles, Boston, and Washington, D.C. San Francisco, with no surprise, anybody who lives in California or follows what's going on in California, and I, as a former resident, know this, you can see San Francisco, major problems, prices projected to decline 40 to 45% between now and 2025. Chicago, New York will see declines 30 to 35%. L.A. and Washington, 25 to 30%. Boston, value slipping around 25%. So you start to think, who's going to eat these losses of these buildings? Well, some of it will be the people that own it. But if they're smart like Ashford Trust, they're looking forward to say, hey, you know what? These experts are saying it's going to get worse. So we're going to get out now, try to hold on to our cash, and maybe come back in and when they're really on a fire sale and buy these assets back for pennies on the dollar. Other cities in its Western Metro's category will suffer comparable valuation declines, such as Seattle, Portland, Denver, and values in southern cities like Miami, Dallas, and Atlanta are looking to fall around 20% or less. And that's largely fueled by the dwindling demand for office buildings as the work-from-home trend persists and the labor market weakens. Now, can you imagine what's going to happen when we actually have a recession and we see, of course, more people laid off? The demand for office space is going to go down, down, and down, right along with prices. The banks will not be able to survive this. Other experts have been warning for trouble for the commercial real estate sector amid struggling post-pandemic demand for office properties and the anticipated crunch in credit conditions, which we've already pointed out that's happening now and only going to get worse. And we know it because that senior loan officer opinion survey, this quarterly report that comes out by the Fed, which is generally a look back. And this is just senior loan officers saying, hey, this is what we did over the last 3 months, in a very rare move at the last report, and we're looking forward to the next one. The last report, they said, we anticipate tightening lending standards through the rest of the year, and that is a dangerous sign, meaning financial conditions are only going to get tighter and real estate prices are coming down. Morgan Stanley, meanwhile, sees a 40% crash in commercial real estate, meaning the sector would suffer an even more severe downturn than it did in 2008. And you can only ask yourself, how many banks will fail? We lost a third of them during the savings and loans crisis. How many more will fail this time? It could be significant. And so now let's go and look, as we talk about the S&L crisis, what was the big catalyst back then that drove the banks out of business? Well, it was a massively inverted yield curve that's only getting worse. Here we can look at the 10-year, 2-year yield curve. This is where we take 10-year yields, subtract 2-year yields. And what we note is that when 2-year yields are way higher than 10-year, that's the inversion shown below the horizontal black line. Go back to the savings and loan crisis. Here you can see a massively, repeatedly inverted yield curve was just disastrous for the banks by the early 1980s all the way through 1993. Even after the curve inverted, the crisis was still burning. And yet you can see the catalyst here. Now you have the largest inversion in the yield curve since the savings and loan crisis. And of course, the good thing is, as we know, the Fed is just asking questions to say, hey, what are you going to do to get out of this problem? Again, as I said, the banks are saying, why did you put us in this place to begin with? As distressed U.S. commercial property assets are now rise to $64 billion, suggesting this problem is going to get worse as another $155 billion of potential stress is looming. Again, talk about devastation to the banks. You talk about rates coming back to zero. You can see it all happening right before your eyes. Higher borrowing costs has pummeled the commercial real estate industry, driving prices lower and causing some owners to choose to default. Much of the potential distress is tied to buildings that need refinancing at a time when lenders are tightening credit, as we've shown, following this collapse of several regional banks. No, it has to do with the yield curve, it has to do with the Fed driving short-term rates up and the economy slowing and the long-term rates not responding. That's what it has to do with this. Should the potential distress be upgraded to full-blown trouble, which it will be, an increase in distressed asset sales and declining prices would be inevitable, as retail properties now include malls that were the most troubled type of real estate, with nearly $23 billion of distressed assets tied to that sector alone. About $18 billion in office buildings were considered distressed at the end of March. So you imagine, we talked already about what happens to commercial real estate when people lose their jobs. What's going to happen to all this retail space when people lose their jobs and cut their spending? You can just see the distress in this economy is going to get out of control. And what does that mean? What is distressed property? Well, it means any property in bankruptcy, default, court administration, liquidation with significant tenant distress. Well, there's a lot of those now. Or if commercial mortgage-backed securities have been transferred to a special servicer. Potentially distressed properties include real estate that faces delays in reselling or leasing, or is debt that's on a commercial mortgage-backed security watch list, is in forbearance, or is in delinquent on payments, which sounds like a huge list, and it is. So the question you're asking, the question everyone wants to know is, well, what are the regulators doing about this? Well, I'm glad you asked. U.S. regulators asked lenders to help firms with commercial real estate stress. That is laughable, sorry. As for financial firms should work prudently and constructively with good clients. Now, of course, not the bad ones. You just let them go. Hopefully they'll go somewhere else. As a government agency said in guidance on Thursday, the statement from the Federal Reserve, Federal Deposit Insurance Corporation, and the Office of Comptroller of Currency and National Credit Union Administration updates guidance on workouts that the watchdogs issued in 2009. And what are they telling people to do? Well, the new guidance recommends that banks grant short-term loan accommodations, which include agreeing to defer payments or accepting partial ones or providing other assistance. It also deals with accounting changes. Next thing you know, they're going to say, hey, maybe you should just not take a payment at all and not cause a loan to default. Look, you can see that regulators, the policymakers, many of you asked, are they that naive? The answer is yes, they are. They can't see what will be the biggest financial crisis since the S&L crisis to hit the banking system. You can see it's happening, and it's starting now. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.